Vietnam wrapped up the first half of 2026 with strong momentum as GDP grew by 8.2%, beating expectations despite geopolitical uncertainty in the Middle East. Although Vietnam is a net energy importer, proactive diplomacy helped secure alternative energy supplies from regional partners, preventing any meaningful disruption. Manufacturing remained firmly in expansion, with the PMI at 51.8. International visitor arrivals increased by nearly 15%, while FDI disbursement rose more than 11%. The main headwind was inflation, which edged up to 4.7% due to higher global oil prices. That in turn led to an increase in bank deposit rates. On the positive side, higher interest rates also helped the Vietnamese dong remain stable despite the stronger US dollar. The strength of the economy is clearly reflected in both reported earnings and the earnings outlook for listed companies, with both delivering double-digit growth. Yet the stock market has largely been a one-man show. The VN Index is up 5.2% year-to-date, but all of those gains have come from Vingroup-related companies. Excluding those names, the broader market has actually drifted lower, weighed down by cautious retail investor sentiment amid higher interest rates and ongoing geopolitical uncertainty. And that's exactly where we see the opportunity. Vingroup-related companies now account for nearly 30% of the index and have inflated the headline valuation, masking what's happening beneath the surface. Looking beyond those stocks, the VN Index is trading at a forward PE of just 10.4 times, representing a 32% discount to regional peers. We expect the economy to maintain solid momentum in the second half, with full-year GDP growth reaching around 7.5%. One of the key growth drivers remains infrastructure investment, which continues to gain traction. This is evident in the strong consumption of steel and cement, up 13% and 16% respectively during the first 5 months of the year. While higher construction material costs remain a challenge, Vietnam's budget surplus of around 3% of GDP gives the government ample fiscal room to sustain spending. In the past, one of the biggest obstacles to public investment was land clearance. Today, that is changing rapidly thanks to regulatory reforms that have significantly reduced bureaucratic red tape. You can already see the impact on the ground. In Thu Thiem, Ho Chi Minh City, land that had sat idle for years has been cleared remarkably quickly, with construction activity now in full swing. The bureaucratic bottlenecks that once delayed projects for years are gradually disappearing, and project execution is clearly accelerating. At the same time, manufacturing activity remains resilient. New orders and production continue to expand, while electricity consumption, up 9.7% year-on-year, provides another strong signal that factories are operating at a healthy pace. As FDI companies continue expanding their operations in Vietnam, we expect manufacturing to remain a key pillar of growth, supporting exports and helping narrow the trade deficit in the second half of the year. The third growth driver is consumption. We expect inflation to ease to around 4.5%, likely past its peak, although still somewhat sticky. To support household spending, the government is implementing a series of tax measures, including a 40% increase in the personal income tax deduction, a matching increase in the dependent deduction, and an 8% rise in base salaries for public sector employees starting in July. Meanwhile, the continued boom in tourism should provide an additional boost, as Vietnam is emerging as one of Southeast Asia's most attractive travel destinations. And finally, there is a quieter but equally important shift taking place. Capital is gradually being redirected away from unproductive assets. Higher mortgage rates are cooling speculative activity in the property market, while the government's crackdown on gold smuggling has narrowed the gap between domestic and global gold prices. Together, these developments are reducing the incentive to park wealth in real estate and gold, encouraging more capital to flow into productive assets instead. Turning back to the paradox of the stock market. If the economy is performing so well, when will the market catch up? We see three key catalysts that could help close that gap. The first is liquidity. Bank deposit rates appear to over their peak, which should encourage part of the savings flowing into banks to rotate back into equities. At the same time, securities brokers still have ample capacity to expand margin lending. From September, another structural tailwind will emerge as FTSE Russell begins the first phase of Vietnam's inclusion into the secondary emerging market index. Earnings outlook is also robust. Top 100 listed companies, excluding Vingroup, is expected to deliver earnings growth of 17% this year and nearly 13% next year. Yet many sectors are still trading near the bottom of their 5-year valuation range. Additionally, Vietnam's steady progress up the global index ladder. Beyond FTSE, we expect Vietnam to be added to the MSCI Emerging Markets watchlist by June 2027. Two key requirements remain, and both are moving in the right direction. The introduction of a central clearing system to fully eliminate pre-funding requirements, which is on track for early 2027, and improved market accessibility for foreign investors through greater English language disclosure, together with a broader free float supported by IPO and state divestments. Overall, we remain constructive on Vietnam's economic and equity market outlook. While inflation is likely to remain somewhat sticky, the broader macro backdrop remains supportive with resilient GDP growth, healthy corporate earnings, and ongoing market reforms reinforcing our confidence at a time when much of the world's capital is concentrated in a handful of AI-driven winners at increasingly demanding valuations. Vietnam offers a different opportunity. Strong economic fundamentals, resilient earnings growth, and continued structural reforms provide a solid foundation while much of the market still trades at attractive valuations. As these fundamentals become more fully reflected in share prices, we believe Vietnam is well positioned to deliver compelling long-term returns.